Before we begin, please note that the information provided in this video is for educational and informational purposes only. I am not a licensed insurance agent or financial advisor. The content presented here is not intended to be a substitute for professional advice. Insurance needs are highly individual, and you should always consult with a qualified professional to determine the best coverage for your specific situation. This presentation does not constitute an endorsement of any particular insurance company or product. All rates and coverages are subject to change and depend on your personal details and the underwriting guidelines of the insurer. You know that feeling. The email lands in your inbox, or the envelope shows up in your mailbox. It's from your car insurance company. You open it, and your eyes immediately scan for that one number, the premium. And there it is. It went up. Again. You haven't had an accident. You haven't gotten a single ticket. Your car is a year older, so it's worth less, not more. So why on earth are you paying more money for the exact same service? It's a frustrating, helpless feeling, and it happens to millions of Americans every 6 months. In fact, a recent study found that the average driver overpays for their car insurance by more than $400 a year. Let that sink in. $400. That's a new set of tires. That's a weekend getaway. That's a significant chunk of your holiday shopping budget. It's your money, and it's leaking out of your bank account simply because the process of shopping for insurance feels complicated, confusing, and time-consuming. Well, today that stops. Today we are going to take back control. The single biggest problem with car insurance is inertia. We get a policy, we set it to autopay, and we forget about it. We accept those creeping rate increases because the alternative, actually shopping around, seems like a massive headache. What information do I need? What do all these terms like bodily injury liability and uninsured motorist even mean? Am I going to get spammed with a million phone calls the second I put my number in? This video is designed to solve that exact problem. We are going to demystify the entire process from start to finish. I'm going to personally walk you through step by step, click by click, how to get a real accurate auto insurance quote from one of the most recognizable names in the industry, MetLife. By the end of this presentation, you won't just have a quote. You will have the confidence and the knowledge to do this with any company, anytime, empowering you to always find the best rate and stop overpaying for good. Now you might be thinking, MetLife? I know them for life insurance, but car insurance? And that's a fair question. MetLife has been a titan in the insurance world for over 150 years, a household name synonymous with stability and trust. But what you might not know is that in 2021, MetLife's auto and home insurance division was acquired by another giant, Farmers Insurance. So when you get a quote for MetLife Auto and Home today, it's actually being offered and serviced by the Farmers Insurance Group. Why is this a good thing for you? Because you get the best of both worlds. You get the legacy and financial strength associated with the MetLife brand, combined with the vast expertise and robust claims network of Farmers, one of the largest and most respected auto insurers in the United States. They consistently receive high marks for financial stability from agencies like AM Best, which means they have the money to pay claims when you need them to. This isn't some fly-by-night startup. This is a deeply established player with a massive infrastructure. Getting a quote from them isn't just a random shot in the dark. It's a smart benchmark to see how your current insurance stacks up against a top-tier competitor. So, what are we actually going to do? We are going to start from a completely blank web browser, just like you would at home. There's no pre-filled information, no special shortcuts. We're doing this live and in real time. I'll show you exactly where to go, what to click, and how to answer the questions the system asks you. But we're going to go deeper than that. When we get to the part about choosing your coverage limits, the part where most people just guess or pick the cheapest option, we're going to pause. I'll explain in plain English what bodily injury liability is, and why picking the state minimum might be one of the most dangerous financial decisions you can make. I'll break down the difference between collision and comprehensive coverage, and help you decide if you actually need both. We'll talk about medical payments coverage, uninsured motorist coverage, and all the other jargon that companies use to confuse you. We're also going to hunt for discounts. Every company offers them, but they're not always obvious. We'll look for everything from good student discounts to safe driver programs, like MetLife's My Journey program, which can offer significant savings based on your actual driving habits. I'll show you how to make sure you're getting every single dollar of savings you're entitled to. The goal here is complete transparency. By the time we're done, you will understand every line item on your quote. You'll know what you're paying for, why you're paying for it, and you'll have a real apples-to-apples comparison to your current policy. This is the skill that saves you not just $100 today, but potentially thousands of dollars over your lifetime as a driver. To get the most out of this walkthrough, I highly recommend you have two things ready. First, your current auto insurance policy's declarations page. This is the summary page that lists all your vehicles, drivers, and current coverage limits. Having this handy will make the process 10 times faster and more accurate. If you don't have a paper copy, you can almost always download it from your current insurer's website. Second, have your driver's license and your vehicle's VIN, or vehicle identification number, ready. The VIN is a 17-digit number usually found on a small plate on the driver's side of the dashboard, visible through the windshield, or on the sticker inside the driver's side door. While you can often get a quote without it, using the VIN ensures the quote is for your exact vehicle model and trim, making it far more accurate. Are you ready? Let's stop talking about saving money and actually do it. Let's pull back the curtain on the insurance industry and put the power back in your hands. Open up a new tab in your web browser. We're going to navigate directly to the MetLife Auto Insurance Quote page, and we're going to start this journey together. Let's begin. The first thing you see is a deceptively simple box. It's asking for your zip code. This isn't just a formality. This single 5-digit number is the first, and arguably one of the most powerful data points you will provide. Before MetLife knows your name, your age, or what you drive, they know your neighborhood. And in the world of auto insurance, where you live is a massive piece of the puzzle. Think about what a zip code represents. It tells them about traffic density. Are you in a quiet, rural area where the biggest risk is a deer? Or are you in a bustling urban center with a fender bender on every corner? It tells them about crime rates, specifically auto theft and vandalism statistics for your area. It even tells them about the weather. Are you in a hail-prone region of Texas or the snowbelt of upstate New York? All of that risk is priced into your premium before you even type your name. So go ahead, enter your zip code and click Get a Quote or Start. You've just laid the cornerstone of your insurance profile. Now you're on the next page. This is where they ask for the basics. Your first name, last name, street address, and date of birth. Let's break this down because again, nothing here is arbitrary. Your name and address are of course for identification, but they're also used to pull data from third-party sources. This is a critical point that trips a lot of people up. Insurance companies use databases like LexisNexis to get a snapshot of your driving history, your claims history, and in most states, a version of your credit score. Let's talk about that for a second. The credit score. I can feel some of you tensing up. You're thinking, is this going to hurt my credit? The answer is no. This is what's known as a soft pull. It's the same type of inquiry that happens when a credit card company sends you a pre-approved offer in the mail. It does not affect your credit score in any way. A hard pull is when you actively apply for a loan, like a mortgage or a car loan. This is different. Insurance companies have found a strong statistical correlation between how a person manages their finances and how likely they are to file a claim. It's controversial, and some states are starting to limit its use, but for now, it's a major factor in most of the country. A better insurance-based credit score can save you a significant amount of money. So be honest with your information. They're going to verify it anyway, and any discrepancies will just cause problems later. Next up, your date of birth. This is one of the pillars of insurance pricing. The entire industry is built on something called actuarial science, using statistics to calculate risk. And age is one of the most reliable predictors they have. We all know that young, inexperienced drivers, especially teenagers, pay the highest rates. Their combination of inexperience and a statistically higher appetite for risk makes them a huge liability in the eyes of an insurer. Rates typically start to come down significantly around age 25, assuming a clean driving record. They continue to drop and then level out through your 30s, 40s, and 50s, which are often considered the sweet spot for the lowest premiums. Then, as you move into your late 60s and 70s, you might see rates begin to tick back up slightly, as statistics show an increase in accident frequency for older drivers. It's not personal, it's just math. It's a game of averages, and your birth date places you on a very specific point on their risk chart. Now, after you've entered your personal details, you'll likely be asked about other people in your household. This is a massive turning point in the quote process, and it's where people make expensive mistakes. The question might be phrased as who else lives with you? Or add another driver. You need to be very careful and very honest here. The rule of thumb is this. You must list anyone in your household of driving age who has access to your vehicles. This includes your spouse or partner, a licensed teenager, a child who is away at college but comes home for breaks, or even an elderly parent who lives with you. Why? Because from the insurer's perspective, anyone living under your roof with a driver's license is a potential driver of your car. They represent a potential risk, and the insurance company needs to account for that risk. Let's say you have a 19-year-old son with 2 speeding tickets. You might be tempted to forget to add him to the policy to keep your rates down. This is a catastrophic mistake. If he borrows your car to go to the grocery store and gets into an accident, the insurance company could deny the claim entirely, leaving you personally responsible for tens or even hundreds of thousands of dollars in damages and medical bills. They would argue that you engaged in material misrepresentation by not disclosing a known driver and a known risk. It is simply not worth it. Conversely, what if you have a roommate? Does your roommate need to be on your policy? Generally, no, as long as they have their own car and their own insurance, and they will never ever drive your car. But if there's a chance your roommate might borrow your car, even once, you should either add them to the policy or, in some cases, you can specifically exclude them. An exclusion is a formal endorsement on your policy that states a specific person is not covered to drive your vehicles under any circumstances. This can be a useful tool, but you must understand that it means what it says. Zero coverage for that person. This is also where you'll add your spouse or domestic partner. In most cases, married couples receive a discount on their auto insurance. Statistically, married individuals are seen as more stable and less risky, so they get a better rate. It's another one of those actuarial quirks that can work in your favor. So as you fill out this section, be thorough. Think about everyone in your home. List them, their dates of birth, and their license information. The system will then pull their driving records, and the quote will begin to take a much more accurate shape. It might make the price go up or it might make it go down, but what's most important is that it will be an honest price for the real risk you represent. Hiding a driver is one of the fastest ways to have a claim denied and a policy canceled. We've now given MetLife the fundamental information about the people who will be covered. They know where you live, which tells them about your environment. They know your age and the ages of the people you live with, which gives them a powerful statistical baseline for your risk. They've done a soft pull on your credit to gauge financial responsibility and cross-referenced your driving records to see your history. The foundation has been laid. The human element of your policy is now in the system. But we haven't even gotten to the most important part yet. We haven't talked about the machine itself. The car. The make, the model, the year, the trim level, the safety features, the anti-theft devices, and that all-important 17-digit vehicle identification number. The story of the drivers is only half the tale. The story of the vehicle is what comes next, and it carries just as much, if not more, weight in determining your final price. Every single detail about your car tells the insurer how much it will cost to fix, how likely it is to be stolen, and how well it will protect you in a crash. We've built the profile of the person behind the wheel. Now we need to build the profile of the metal, glass, and rubber they're driving. So let's start with the first vehicle. For most of us, this is our daily driver, the one that gets us to work, to the grocery store, to our kids' soccer practice. MetLife, like every insurer, needs to know this car inside and out. They start by asking for the year, make, and model. This is the holy trinity of vehicle identification. A 2023 Honda CR-V tells a completely different story than a 2013 Dodge Charger, which tells a different story than a 1998 Ford F-150. Just with those 3 pieces of information, their system is already pulling a mountain of data. It's looking at crash test ratings from the Insurance Institute for Highway Safety. How does this car perform in a front-end collision? A side impact? A rollover? A car with a top safety pick plus. Rating is a car that protects its occupants, and protected occupants mean lower medical payment claims. That's a win for you and a lower risk for them. It's also looking at repair costs. A bumper replacement on a standard sedan might be $1,000. That same replacement on a luxury SUV with embedded sensors, cameras, and specialized paint could be 3, 4, or even 5 times that amount. The system knows this. It knows which models have parts that are readily available and affordable, and which ones require expensive, foreign-made components that take weeks to ship. And then there's theft. The system knows which cars are hot targets for thieves. Historically, vehicles like the Honda Civic and Accord, or full-size pickups like the F-150 and Chevy Silverado, have been at the top of the list. Why? Because there are so many of them on the road, their parts are in high demand on the black market. Your car's make and model instantly flags its desirability to criminals, which directly impacts the comprehensive coverage portion of your premium. But year, make, and model is just the broad strokes. The real magic happens with the VIN, the vehicle identification number. You'll see a field for this, and I highly recommend you use it. Don't just manually enter the make and model if you can avoid it. Why? Because the VIN is your car's unique fingerprint. It's a 17-digit code that tells the insurance company everything. It doesn't just say Ford Explorer. It says a Ford Explorer XLT trim, built in Chicago, Illinois on this date, with this specific engine, and equipped with the optional advanced safety package. That last part is critical. The VIN tells them if you have anti-lock brakes, electronic stability control, lane keeping assist, or automatic emergency braking. These are features that can actively prevent an accident. If you just manually select Ford Explorer, the system might not know you have those safety features, and you could be leaving discounts on the table. The VIN removes all ambiguity. It is the single most accurate source of truth about your vehicle, and it allows MetLife to give you the most accurate and potentially cheapest quote. Next, you'll likely be asked about the vehicle's ownership. Is it owned, financed, or leased? This seems like a personal financial question, but to an insurer, it's a fundamental question about risk and requirements. If you own your car outright, meaning you have the title free and clear, you have total control. You can choose to carry only the state minimum liability insurance if you want. You're accepting the risk that if you crash the car and it's your fault, you'll be paying for your own repairs out of pocket. But if you finance or lease the car, you are not the only one with a financial interest in it. The bank that gave you the loan or the company that holds the lease is what's known as a lien holder. They technically own a piece of your car until it's paid off. And because it's their asset, they get to set some rules. And rule number 1 is always this: you must protect their asset. This means they will require you to carry not just liability, but also collision and comprehensive coverage, often with a maximum deductible of $500 or $1,000. This ensures that if the car is stolen, totaled in an accident, or damaged by a hailstorm, there is an insurance policy to pay for it, making the lien holder whole. So when you tell MetLife your car is financed, their system automatically knows that certain coverage levels aren't just recommended, they're mandatory. This isn't MetLife being difficult. It's them making sure your policy complies with the terms of your loan or lease agreement. It's a crucial detail. Now we move from what the car is to how the car is used. You'll be asked for its primary use. The options are usually commute, pleasure, business, or farm. Let's break these down. Pleasure use means you don't use the car for a regular, daily commute to work or school. It's for errands, weekend trips, and general driving around. This is typically the lowest risk category because the mileage is often lower, and you're not usually driving during the most congested rush hour periods. Commute is what most of us select. This tells the insurer you're on the road at the same time as everyone else 5 days a week, heading to and from a specific location. They'll ask for the one-way distance of your commute. This helps them build a more precise risk profile. A 5-mile commute through suburban streets is very different from a 50-mile commute on a packed interstate. Business use is a critical distinction. This is for when the vehicle is an integral part of your job. Think real estate agents driving clients, contractors hauling tools and materials, or a salesperson traveling a multi-state territory. This is a significantly higher risk. You're putting on more miles, you're often in unfamiliar areas, you might be carrying valuable equipment, and you're under the pressure of a schedule. If you use your vehicle for business, you must declare it. Hiding this fact could lead to a claim being denied. In some cases, especially if you're a sole proprietor or have a small business, MetLife might even suggest you need a commercial auto policy, which offers different and more robust protections. Finally, you'll be asked to estimate your annual mileage. This is one of the most direct measures of your exposure to risk. The math is simple. The more you're on the road, the more likely you are to be involved in an incident. The average American drives somewhere between 12,000 and 15,000 miles per year. Think about your daily commute, add in weekend driving, errands, and any road trips you take. Be honest, but be realistic. If you tell them you drive 5,000 miles a year but your commute is 40 miles round trip, that's 200 miles a week right there. Over 50 work weeks, that's 10,000 miles before you've even gone to the grocery store. The numbers need to make sense. A low annual mileage can lead to significant discounts because you're a lower risk. This is also where telematics programs come into play. MetLife has a program that uses a smartphone app to track your actual driving habits and mileage, potentially earning you a discount based on how you truly drive, not just an estimate. We'll dive deeper into those specific discounts later in the series. So let's recap what we've done. We've given the car an identity with its year, make, model, and VIN. We've established its financial situation and the coverage requirements that come with it. And we've defined its purpose and its journey through its primary use and annual mileage. We have now created a complete, data-rich profile of the vehicle. The insurer's computer now sees a high-resolution picture of this car, its safety features, its repair costs, its theft risk, and its daily life. But a car is just one half of the equation. A car doesn't drive itself, at least not yet for most of us. The single biggest factor in determining your rate is still the person or people sitting in the driver's seat. So now that we have the profile of the machine, we need to officially pair it with the profile of the human. We need to tell MetLife who will be driving this car. And that's where the next layer of the risk calculation really begins. This is where the algorithm shifts its focus from horsepower to human behavior. MetLife has analyzed the car. Now it needs to analyze the driver. And every single question from here on out is designed to build a statistical sketch of you. It's not personal, it's actuarial. The first few fields are the easy ones. First name, last name, and date of birth. This is standard identity verification, but your date of birth is the first major data point for the risk calculation. It's no secret that age is one of the biggest factors in determining your premium. Statistically, the youngest drivers, especially teenagers, and the oldest drivers, say over the age of 75, are involved in more accidents per mile driven. So if you're a 17-year-old male, the algorithm immediately flags you as a higher risk than a 45-year-old female. It's just a numbers game based on decades of collision data. You can't change your age, but understanding why they ask is the first step in demystifying this whole process. Next, they'll ask for your gender. Now, this is a bit of a controversial data point, and some states are actually starting to ban its use in setting insurance rates. But in most places, it's still part of the equation. Historically, men, particularly young men, have been shown to engage in riskier driving behaviors. More speeding, more DUIs, less seatbelt use, leading to more frequent and more severe accidents. As a result, they often pay higher premiums. Again, it's not a judgment on you as an individual. It's a broad statistical correlation that the insurance company uses to predict future losses. Then comes a question that feels deeply personal but to the insurer is purely statistical: your marital status. Single, married, divorced, widowed. Why on earth would this matter? The data across almost every major insurer shows a very clear trend. Married drivers file fewer claims. The prevailing theory is what actuaries call a lifestyle factor. The assumption is that getting married is a sign of stability and responsibility. Married individuals are perceived as being more cautious, less likely to be out late at night, and perhaps have more to lose, making them safer drivers overall. So, if you're married, you will almost always see a slight discount on your premium. It's one of the easiest discounts to get, simply by checking a box that reflects your life stage. Now we move from the demographic profile to the driving profile. This is the moment of truth. The system will ask about your driver's license. Is it active? Is it valid in your state? This is a fundamental check. If you don't have a valid license, you can't be insured, full stop. Then come the heavy hitters. The questions about your driving record for the past 3 to 5 years. They'll ask, have you had any accidents, claims, or losses? And have you had any violations or convictions? This is the part where people get nervous. The temptation to fudge the details can be strong. Maybe you had a little fender bender 2 years ago that you handled in cash. Maybe you got a speeding ticket you'd rather forget. Here is my most critical piece of advice for this entire process. Be 100% honest. Do not lie. Do not omit anything. It's not a moral judgment. It's a practical one. Insurance companies don't just take your word for it. They have access to massive interconnected databases. The primary one is called the CLUE report, which stands for Comprehensive Loss Underwriting Exchange. Think of it as a credit report for your insurance history. It contains a 7-year record of every auto and property claim you've ever filed. When you submit your quote, MetLife will almost instantly pull your CLUE report and your official motor vehicle report, or MVR, from the DMV. If you claim a clean record but your MVR shows a speeding ticket from 18 months ago, the system will catch it. If you forget to mention the accident where you rear-ended someone, but the other driver's insurance company filed a claim that ended up on your CLUE report, they will find it. And what happens then? At best, your quote will be recalculated and it will be much higher. At worst, they could deny you coverage altogether for material misrepresentation. simply not worth the risk. So, when the form asks about accidents, list them. It will typically ask for the date of the incident and a general description of what happened, for example, at-fault collision, or not-at-fault weather-related damage. Being not at fault is obviously much better, but even an at-fault accident isn't the end of the world. A single minor accident from a few years ago might only have a modest impact on your rate, especially if you have a long history of otherwise safe driving. The same goes for violations. A ticket for rolling through a stop sign is different from a conviction for a DUI. The system weighs the severity. Be prepared to enter the date and the type of violation. The key is to own your history. The algorithm is designed to price the risk you actually represent, not the risk you wish you represented. Honesty ensures you get a real bindable quote that won't suddenly skyrocket a week after you've paid for it. After the confessional of your driving history, we get to some more positive questions, the ones that can actually save you money. One of the biggest is your level of education. MetLife, like many insurers, offers discounts for having a college degree or higher. Why? Once again, it's all about statistics. Data suggests that individuals with higher levels of education tend to file fewer claims. It's another proxy for a stable, lower-risk lifestyle. And for younger drivers still in school, this is where the all-important good student discount comes into play. If you're a full-time student, typically under the age of 25, and you maintain a B average or better, usually a 3.0 GPA, you can get a significant discount. We're talking up to 15 or 20% off your premium. You will need to be able to provide proof like a recent report card or transcript if they ask for it, so make sure you qualify before you check that box. Finally, in this section, they'll ask for your occupation. This one surprises a lot of people. What does being a teacher, an engineer, or a salesperson have to do with your driving? The insurance company sees a correlation. Certain professions are statistically safer than others. For example, teachers, scientists, and pilots are often considered low risk. Their jobs are seen as detail-oriented and responsible. On the other hand, jobs that involve a lot of driving, like delivery drivers or high-stress jobs like doctors or lawyers, might be viewed as slightly higher risk. The company isn't judging your career choice. It's using it as yet another data point to refine its prediction of how likely you are to file a claim. Some insurers even offer specific affinity discounts for people in certain professions, like educators or first responders. So let's recap where we are. We've given MetLife a complete picture of the car, its make, model, age, and safety features. Now we've attached a human to that machine. They know your age, your marital status, your education, your job, and most importantly, your driving history. The algorithm has taken all of these inputs and is building a complex, multi-layered risk profile, starting to get a very clear idea of who you are. But the picture isn't complete, because you might not be the only person driving this car. And that introduces a whole new set of variables that we need to account for. This is where the quote process gets personal, not just for you, but for everyone in your household. MetLife and every other insurer needs to know about every potential driver who has regular access to your vehicle. This isn't about being nosy. It's about one of the most fundamental principles of insurance. The premium must reflect the total risk. And the risk isn't just you. It's a composite of everyone who might get behind the wheel. Think of your car insurance policy as a protective bubble around your vehicle. The price of that bubble is determined by the likelihood of it being popped. If you're the only one driving, the calculation is based on your history, your habits, your data. But the moment you hand the keys to your spouse, your teenage son, or even your roommate, you've introduced their entire driving identity into the equation. Their history becomes part of your policy's risk profile. So, as we move to the driver's section of the MetLife quote, you'll be asked to add a driver. This is where you need to be brutally honest and thorough. The first fields are straightforward: first name, last name, and date of birth. This is the baseline information used to identify the individual, and, with your permission, pull their official driving records and claims history. We'll get to that part later, but for now, just know that accuracy here is non-negotiable. A typo in a name or a swap digit in a birth date can lead to pulling the wrong person's record, which could either incorrectly inflate your quote or cause major problems down the line if the policy is issued with incorrect information. Next, you'll likely see fields for gender and marital status. Now, these can feel a bit old-fashioned, but they are still powerful data points in the actuarial world. For decades, statistics have shown a strong correlation between these factors and driving risk. For example, data has consistently shown that, as a group, married individuals file fewer and less expensive claims than single individuals. The logic is that marriage is often associated with a more stable, risk-averse lifestyle. Similarly, gender has historically been a rating factor because statistically, young male drivers have a much higher frequency of high-speed accidents and DUIs compared to their female counterparts. While some states are now banning the use of gender as a rating factor, it's still used in many places. It's crucial to understand. The insurance company isn't making a personal judgment about you or your spouse. They are playing a game of statistics, using massive data sets to predict future behavior. They are matching your profile to millions of others to see where you fit on the risk spectrum. Then you'll specify the driver's relationship to you: spouse, child, parent, or other. This helps the system understand the household composition. A spouse is typically considered a co-owner of the risk. A child, especially a teenage one, represents one of the most significant shifts in a policy's risk profile that a family will ever experience. And this brings us to one of the most common and costly mistakes people make: omitting drivers who live with them. Let's play out a few scenarios. Scenario 1. The college student. Your daughter is away at college, 200 miles from home. Her name is on your policy and it's costing you a fortune. You think, she doesn't even have the car with her. I'll just remove her from the policy for the school year to save money. This is a massive gamble. The moment she comes home for Thanksgiving break and borrows your car to see high school friends, you are likely uninsured for her actions. Most policies require that all licensed household members be listed. Even if they're temporarily living elsewhere, they are still considered part of the household. If she causes an accident during that holiday break, the insurance company has every right to deny the claim, arguing that you materially misrepresented the risk by intentionally omitting a known driver. You saved a few $100s on the premium, only to be left personally liable for a $50,000 accident. Scenario 2. The roommate. You share an apartment with a friend. You have a car, they don't. They occasionally borrow it to go to the grocery store. You think, it's no big deal, they're a good driver. So you don't add them to your policy. Here we enter the gray area of permissive use. Most policies will cover a driver you give occasional, one-off permission to use your car. But the definition of occasional is dangerously vague. If your roommate starts using your car every Tuesday and Thursday to get to their part-time job, that's no longer occasional use. That is regular and frequent access. They have, in the eyes of the insurer, become a primary operator of the vehicle. If they get into an accident on the way to that job, your claim could be denied. The insurer will argue that this person was a de facto unlisted household driver, and had they known about this regular use, your premium would have been higher. It's a breach of your policy contract. The golden rule is this: if a licensed driver lives in your household, you must list them on the policy. Period. This includes your spouse, a partner you live with, a licensed teenager, a child home from college, or even an elderly parent who lives with you and still drives. Now, what if one of those household members has a truly terrible driving record? A DUI, multiple at-fault accidents, a suspended license. Adding them to your policy could cause your rates to double or even triple. You might not even be able to get coverage at all. In this situation, you have an option, but it's the nuclear option: a named driver exclusion. This is a formal endorsement to your policy where you and the insurance company agree, in writing, that a specific person in your household is explicitly excluded from all coverage. By signing this, you are swearing that this person will not, under any circumstances, drive your insured vehicles. This can dramatically lower your premium, because the insurer is no longer underwriting that person's risk. But the consequences are severe. If that excluded driver gets behind the wheel of your car, even in a dire emergency, and crashes, there is zero coverage. Not for the damage to your car, not for the damage to other cars, and certainly not for any injuries. It's as if you had no insurance at all at that moment. You would be personally responsible for every single dollar of damage. It is a tool to be used only when you can absolutely guarantee that person will never, ever drive your car. For every driver you add, the MetLife system is running these complex calculations in the background. It's not just you plus one. It's taking driver A's age, gender, marital status, and driving history, and blending it with driver B's age, gender, marital status, and driving history. It's creating a new combined household risk score. It's looking for correlations. A married couple in their 40s with clean records is one risk profile. That same couple with an added 17-year-old son is a completely different and exponentially higher risk profile. So as you fill out this section, be meticulous. Add every licensed driver in your home. Double-check their names and birth dates. It might be tempting to forget about your son who just got his license, or your roommate who uses the car twice a week. But that small omission is a crack in the foundation of your policy. And when a claim happens, that's exactly where the pressure will be applied. A denied claim can be financially ruinous, far outweighing any savings you might have gotten from hiding a driver. You are building a complete and honest picture for the insurer. You've told them about you, the primary driver. You've detailed the vehicle you want to protect. And now, you've introduced the entire cast of characters who have access to that vehicle. The who and the what are now on the table. But MetLife is still missing a critical piece of the puzzle. It knows who is driving, but it doesn't yet officially know how they drive. And that's the next and arguably most important layer we're about to add. The detailed driving history, the accidents, the tickets, and the violations that truly define your risk on the road. This is the moment of truth. Up until now, MetLife's system has been making educated guesses. It knows your age, your gender, where you live, and what you drive. It's built a demographic sketch, a statistical ghost of you as a driver. But it's all being based on averages and assumptions. Now we get to the facts. We get to the part of the application that separates the safe from the sorry, the cautious from the careless. We are entering the driving history section. This isn't just a formality. It's the heart of the underwriting process. It's where the algorithm stops generalizing and starts personalizing your rate based on your actual, documented behavior behind the wheel. Think of it from the insurance company's perspective. Their entire business model is a high-stakes bet. They are betting that the money they collect from you in premiums will be more than the money they have to pay out for your claims. And the best predictor of future behavior is past behavior. So when they ask about your driving history, they're not trying to judge you. They're trying to calculate the odds. Every question they ask is designed to sharpen their prediction of how likely you are to cost them money in the future. The first major category you'll encounter is accidents. The screen will likely ask something straightforward like, in the past 5 years, has any driver on this policy been involved in an accident, regardless of fault? Let's break that question down because every word matters. Past 5 years is the typical look-back period. An accident from 6 or 7 years ago has likely aged off your record and won't be a factor for most standard insurers. It's essentially been forgiven by the system, but anything within that 5-year window is fair game. The next critical phrase is, any driver on this policy. If you're adding your spouse or a teenage child, their history becomes your history for the purpose of this quote. An accident caused by your 17-year-old son 2 years ago will absolutely impact the premium for the entire household. It's a package deal. And the final, most important part, regardless of fault. This trips a lot of people up. You might be thinking, well, I was rear-ended at a stoplight, it wasn't my fault, so I don't need to mention it. That is a huge mistake. You must disclose every single incident. Why? Because the insurance companies have a secret weapon, and it's called the CLUE report. CLUE stands for Comprehensive Loss Underwriting Exchange. It's basically the credit report for your insurance life. Every time you file a claim, whether it's for an auto accident, a homeowner's claim for a leaky roof, anything, it gets logged in this massive, shared database that almost all insurers use. When you apply for a quote, MetLife will, with your permission, pull your CLUE report. If you say you have no accidents, but your CLUE report shows a $10,000 payout from 2 years ago when someone hit you, the system flags an immediate discrepancy. At best, it forces a correction and a much higher quote. At worst, it can lead to your application being denied outright for what's called material misrepresentation. Lying or even omitting information is the fastest way to get blacklisted. So, the golden rule here is radical honesty. Disclose everything because they're going to find out anyway. Now, once you say, yes, I've had an accident, the system will drill down for details. It'll ask for the date of the incident, which driver was involved, and the crucial question, were you at fault? This is where the distinction matters. A not-at-fault accident, where another driver's insurance paid for everything, has a much smaller impact on your rate than an at-fault accident. Some states even have laws preventing insurers from raising your rates for a not-at-fault claim. An at-fault accident, however, is a direct red flag. It tells the insurer that you, the driver, made a mistake that resulted in a financial loss. The system will then ask for more specifics. Was it a major or minor accident? This is usually defined by the total cost of the claim. A minor accident might be anything under $2,000. A cracked bumper, a dented door. A major accident involves significant damage, multiple vehicles, or most importantly, injuries. If you check the box that says injuries were involved, you can expect the algorithm to take that very seriously. A $5,000 property damage claim is one thing. A $50,000 bodily injury claim is a completely different level of risk. The system sees that and thinks, this driver was involved in an incident so severe that a person's physical well-being was compromised. The potential for a future high-cost lawsuit is significant. This is where the surcharge comes in. An at-fault accident will typically add a surcharge to your policy that lasts for 3 to 5 years. It's a penalty that decays over time. After the first year, it might be a 40% surcharge. After the second, 30%, and so on until after 3 or 5 years of clean driving, it disappears completely. Your job as a consumer is to drive safely and let time heal that financial wound. Once we're through the minefield of accidents, we move on to the next category: violations and tickets. These are different from accidents because they don't necessarily involve an insurance claim, but they are direct, government-documented evidence of risky driving. Just like with the CLUE report for accidents, insurers have access to your MVR, or motor vehicle report, directly from your state's DMV. This is your official driving record. Trying to hide a speeding ticket is like trying to hide your age from the government. The data is already there. The application will ask, in the past 3 to 5 years, has any driver received any tickets or had their license suspended or revoked? Again, be honest. When you say yes, a new menu will appear, listing different types of violations. And it's critical to understand that not all violations are created equal. There is a clear hierarchy of severity. At the bottom of the pyramid, you have minor infractions. Things like a parking ticket or a fix-it ticket for a broken taillight usually don't even need to be reported, and often don't affect your insurance rates at all. Slightly above that are minor moving violations. A speeding ticket for going 10 to 15 miles per hour over the limit, a rolling stop at a stop sign. These will cause a small to moderate increase in your premium. They signal a bit of carelessness, but they aren't seen as deeply reckless. Then you climb the ladder to major moving violations. This is where the financial penalties really start to sting. We're talking about speeding in a school zone, reckless driving, or getting a ticket for going more than 25 or 30 miles per hour over the limit. These actions demonstrate a significant disregard for safety, and your premium will reflect that with a hefty surcharge. And at the very top of the pyramid, the absolute worst-case scenario for your insurance rates is the catastrophic violation, a DUI or DWI. Driving under the influence is the ultimate red flag for an insurance company. It is a toxic combination of poor judgment and extreme risk that can lead to devastating accidents. A single DUI can cause your rates to double, triple, or even quadruple. Many standard insurance companies, like MetLife, might even refuse to cover you altogether, forcing you into a high-risk insurance pool with astronomical premiums. A DUI can haunt your insurance record for 7 to 10 years, sometimes longer depending on the state. It is the financial equivalent of a nuclear bomb on your auto insurance. For each violation you list, the system will ask for the date and the specific driver. It then cross-references this with your MVR and feeds it into the pricing algorithm. A single 2-year-old speeding ticket for your spouse might only add $10 a month. But your own recent reckless driving violation combined with an at-fault accident from last year? Now the system sees a pattern. The algorithm isn't just adding up individual events. It's analyzing the combination of events. It's building a narrative about you as a driver. A clean record tells a story of a safe, predictable client. A record littered with accidents and violations tells a story of a high-risk, unpredictable client who is statistically much more likely to file a claim in the near future. By the time we finish this section, MetLife's system will have a complete, multi-layered picture of every driver in your household. It has moved beyond simple demographics. It now has the hard data, the documented history of every mistake, every claim, and every citation. This profile, your unique risk fingerprint, is the primary engine that will drive the final price. With our risk profile now crystal clear to the system, it's time to move from the who and the how to the what. What exactly are we insuring against? We're about to build the fortress of protection around you in your vehicle piece by piece. This is where the quote process transforms from a series of questions about your past into a series of choices about your future. Every click you make on this page is a decision about how protected you want to be when things go wrong. This isn't just about ticking boxes. It's about building your personal financial shield. First up, the cornerstone of any auto insurance policy: liability coverage. Think of this as the bare minimum, the foundation upon which everything else is built. In fact, it's so fundamental that it's legally required in almost every state. But here's the critical thing to understand. Liability coverage isn't for you. It doesn't pay a single dollar to fix your car or cover your medical bills. It pays for the damage you cause to other people and their property. You'll see it broken down into two parts: bodily injury liability and property damage liability. Bodily injury covers medical expenses, lost wages, and even legal fees if you injure someone in an accident that's your fault. Property damage covers the cost of repairing or replacing the other person's car, or maybe that fence you backed into, or a mailbox you knocked over. Now you'll see these numbers that look like a secret code, something like 25/50/25 or 100/300/100. It's not as complicated as it looks. The first number is the maximum amount in thousands of dollars the policy will pay for injuries to a single person. The second number is the maximum it will pay for total injuries for a single accident. And the third number is the maximum it will pay for property damage. So a 25/50/25 policy covers up to $25,000 for one person's injuries, $50,000 total for everyone's injuries in the car you hit, and $25,000 for their property damage. Now you might be tempted to just select your state's minimum requirement to get the lowest possible price. And you can. But let me paint a quick picture for you. The average new car in America costs over $45,000. If you have a policy with only $25,000 in property damage, and you total someone's brand new SUV, guess who's on the hook for the remaining $20,000? You are. They can sue you. They can go after your savings, your assets, even garnish your future wages. Suddenly, saving a few bucks a month by choosing minimum liability seems like a catastrophic gamble. This is one of the most important decisions you'll make. Bumping those liability limits up is often one of the most cost-effective ways to buy a massive amount of peace of mind. Okay, with the foundation laid, let's talk about protecting your own vehicle. This is where collision and comprehensive coverage come in. They are the walls and the roof of your fortress. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object, another car, a pole, a guardrail, or if it rolls over. This is the coverage that handles the aftermath of that fender bender in the grocery store parking lot, or that misjudged turn on an icy road. It doesn't matter who was at fault. If you have collision, your car gets fixed. When you select collision, you'll also have to choose a deductible. The deductible is the amount of money you have to pay out of your own pocket before the insurance company starts paying. Deductibles typically range from $250 to $1,000, or even more. This is a classic risk-reward scenario. If you choose a high deductible like $1,000, your monthly premium will be lower. But if you get in an accident, you have to be ready to write a check for that full amount. If you choose a low deductible like $250, your premium will be higher, but your out-of-pocket cost after an accident is much more manageable. The right choice here depends entirely on your personal financial situation. Do you have $1,000 sitting in an emergency fund? If not, a lower deductible might be the smarter, safer play, even if it costs a bit more each month. Next to collision, you'll see its partner, comprehensive coverage. If collision protects you from crashes, comprehensive protects you from pretty much everything else. Think of it as the coverage for chaos and acts of God. This is what pays out if your car is stolen, if a tree branch falls on it during a storm, if it's damaged by fire, flood, or a hailstorm that makes it look like a golf ball. It also covers vandalism, and very commonly, hitting an animal like a deer. Just like with collision, you'll choose a deductible. Many people choose to have the same deductible for both, but you can mix and match depending on what you think the bigger risk is in your area. Do you live in a place with a lot of deer or frequent hailstorms? Comprehensive is your best friend. Now, it's important to note that if you have a loan or a lease on your car, your lender will almost certainly require you to carry both collision and comprehensive. They have a financial stake in your vehicle, and they want to make sure their investment is protected. If you own your car outright, the choice is yours. For an older car that's not worth very much, you might decide to save some money and skip these coverages. But for any car with significant value, going without them is like leaving the doors to your fortress wide open. So we've covered damage you cause to others, and we've covered damage to your own car. But what about you? What about your own medical bills? This brings us to a crucial, and often overlooked, set of coverages. Let's start with uninsured and underinsured motorist coverage. This might be one of the most important things you add to your policy, We'd like to believe that every other driver on the road is as responsible as we are. But the reality is they're not. It's estimated that 1 in 8 drivers in the United States is uninsured. That's a terrifying statistic. Here's what happens. Someone runs a red light and plows into you. It's clearly their fault. Your car is wrecked and you have thousands in medical bills. But then you find out the other driver has no insurance. Zero. Without uninsured motorist coverage, you are completely on your own. You'd have to sue them personally, which is a long, expensive process, and even if you win, you can't get blood from a stone. If they couldn't afford insurance, they probably can't afford to pay your medical bills. Uninsured motorist coverage steps in and acts like the other driver's insurance. Pays for your medical expenses and, in some states, even lost wages. Underinsured motorist is similar. It kicks in when the at-fault driver has insurance, but their liability limits aren't high enough to cover all of your bills. This coverage is your personal safety net against the irresponsibility of others. Next, you'll likely see an option for medical payments, often called MedPay, or in some states, personal injury protection or PIP. This is another layer of protection for you and your passengers. It helps pay for medical and funeral expenses after an accident, no matter who is at fault. If you and your friends are in the car and get into an accident, MedPay can cover the ambulance ride, the emergency room visit, x-rays, and so on, for everyone in your vehicle up to the limit you choose. It's designed to pay out quickly to cover those immediate costs, long before any fault has been determined or any settlements have been reached. It's the first responder of your insurance policy. Finally, we get to the optional extras, the upgrades to your fortress. These are things like rental reimbursement and roadside assistance. Rental reimbursement does exactly what it says. If your car is in the shop for a covered repair, it helps pay for a rental car so you're not left stranded. Think about it. If your car is your only way to get to work, and it's going to be in the body shop for 2 weeks, this small monthly add-on can be an absolute lifesaver. Roadside assistance is that classic peace of mind for a flat tire, a dead battery, running out of gas, or locking your keys in the car. It's a convenience, but when you're stuck on the shoulder of a highway at night, that convenience feels priceless. As you click through and select these coverages and limits, you are actively defining the line between a minor inconvenience and a financial catastrophe. Each choice, from raising your liability to lowering your deductible, is a direct trade-off between your monthly premium and your potential risk. You are in the driver's seat, not just of your car, but of your financial security. Now that we've constructed the policy and built the walls of our fortress, the system has almost everything it needs. The next step is to see how we can lower the cost of all this protection. We're about to hunt for every single discount you're entitled to. This is where the game is won or lost. It's the treasure hunt at the end of the map. We've done the hard work of defining our coverage, and now we get our reward. This isn't just about ticking boxes. It's about strategically claiming every single dollar you're rightfully owed back. Every discount an insurance company offers is a signal. It's them telling you, if you do this or if you are this, you are a better risk for us and we will pay you for it. It's a performance bonus for being a responsible person. So let's get you paid. We'll break this hunt into 4 key areas. Discounts for who you are as a driver, discounts for the car you drive, discounts for how you structure your policy, and finally a secret weapon discount that most people completely miss. First, let's talk about you, the driver. The single most powerful discount in your arsenal is the good driver, or safe driver discount. This is the big one. It's the insurance world's gold star. It's based on your driving record over the last 3 to 5 years. No at-fault accidents, no major violations like a DUI or reckless driving, and often no minor tickets either. Think of your driving record not as a history of your mistakes, but as your financial resume for an insurance company. A clean resume gets you the corner office with a view. A messy one gets you a higher premium. When the MetLife system asks about your driving history, this is your moment to cash in on years of responsible driving. Every day you drove without an incident, you were earning this discount. Don't leave it on the table. Next up, for those of you with younger drivers on your policy, or if you're a student yourself, is the good student discount. This can be a massive savings. Why do they care about grades? Because data across millions of drivers shows a powerful correlation. Students who are responsible enough to maintain a B average or a 3.0 GPA are statistically less likely to be in an accident. They're more disciplined, more forward-thinking. So if you or your child is on the dean's list, in the top 20% of their class, or meets that GPA threshold, it's not just a point of pride, it's a bargaining chip. Have that report card or transcript ready. It's proof that you're a lower risk, and MetLife will reward you for it. What if you're not a student and your driving record isn't perfect? There's still hope. The defensive driving course discount. This is you proactively telling the insurance company, I am investing my own time and money to become a safer driver. You're raising your hand and showing initiative. These state-approved courses, often available online for a small fee, can teach you accident avoidance techniques and refresh your knowledge of traffic laws. Completing one can not only knock points off your license in some states, but it also shows the insurer you're committed to safety. It's a small investment that can pay dividends for years on your premium. Now for the modern high-tech discount. Usage-based insurance. With MetLife, this is often through their My Journey program. This is where you move from being judged by demographics, your age, your zip code, to being judged by your actual real-world driving habits. You agree to use a smartphone app or a small device that plugs into your car, and it measures how you drive. We're talking about things like hard braking, rapid acceleration, the time of day you drive, avoiding those risky late-night hours, and your total mileage. Let's address the elephant in the car. Privacy. Yes, it's tracking your driving, but the trade-off is control. If you are a genuinely safe, low-mileage driver stuck in a high-rate demographic, this is your chance to prove it. You're saying, don't look at the statistics for my age group. Look at my data. I am the exception. For many, the savings are substantial, often one of the biggest discounts available, especially if you work from home or are just a careful, conscious driver. It's the ultimate show don't tell discount. Okay, that covers the driver. Now let's move to our second category, the vehicle itself. Your car is your suit of armor on the road, and insurers will give you a discount if that armor is top-notch. We're talking about vehicle safety feature discounts. Does your car have anti-lock brakes? That reduces your risk of skidding into an accident. Automatic seatbelts or airbags. That reduces the risk of injury if you are in a crash, lowering potential medical claim costs. Daytime running lights? They make you more visible to other drivers. The system will ask you about these features. Know your car. Every safety feature it has is a potential discount. And it's not just about surviving a crash, it's about preventing theft. If your car has a passive anti-theft system, meaning an engine immobilizer that works automatically, that's a discount. If you have an active system like LoJack or OnStar that can help recover the vehicle if it's stolen, that's often an even bigger discount. Why? Because it makes it less likely the insurance company will have to write a massive check to replace your entire car. Now for our third category, and this is where we get into the really big strategic savings, policy-level discounts. The undisputed king of this category is the multi-policy, or bundling discount. This is the loyalty super bonus. Insurance companies love customers who trust them with more than one line of business. If you get your auto insurance from MetLife, and you also get your home, renters, or condo insurance from them, they will give you a significant discount on both policies. It's a win for them because it makes you a stickier customer, less likely to shop around every 6 months. And it's a massive win for you. We're not talking about a few dollars here. This can often be a 10, 15, or even 20% savings. When you're going through the quote, if you have a home or renter's policy elsewhere, always get the bundled quote to see the difference. It's often the single largest discount you can get. A close cousin to this is the multi-car discount. If you have more than one vehicle in your household, insuring them all on the same policy with MetLife will almost always be cheaper than getting separate policies for each. It's an efficiency discount. It's cheaper for them to manage one policy with 2 cars than 2 separate policies. Next up is the paid in full discount. Insurance companies give you the option to pay your premium monthly. It's convenient, but you pay a small price for that convenience. They have to process more payments, and they carry the risk that you might miss a payment. If you can afford to pay your entire 6-month or annual premium all at once, they will reward you for it. You give them all the money up front, they reduce their administrative costs and their risk, and you get a nice discount in return. If you have the cash flow, it's essentially free money. And on a similar note, the paperless and auto-pay discounts. These are small, but they are the easiest discounts in the world to get. By agreeing to receive your documents by email instead of snail mail, you save them printing and postage costs. By setting up automatic payments from your bank account or credit card, you ensure they always get paid on time. They pass a little bit of that savings and security on to you. It might only be a few bucks per policy period, but why would you say no to that? It's a 2-click discount. Finally, we arrive at our fourth category, the secret weapon, affiliation or group discounts. This might be the single most overlooked high-impact discount in the entire insurance world. MetLife, in particular, has a long history of partnering with large companies and organizations to offer special group rates to their employees or members. This is where you need to put on your detective hat. Did you get your insurance information through your employer's benefits portal? That's a huge clue. Are you a member of a certain professional organization, a university alumni association, a credit union, or even a government entity? Many of these groups have negotiated a special discount for their members. The quote process will have a section where you can search for your employer or affiliated group. Do not skip this step. Take the 30 seconds to type in your company's name. Finding your group here can unlock a preferred rate that isn't available to the general public. It's like having a secret password that gets you a better price, and it's astonishing how many people don't even know they have it. So, as we fill out this section of the quote, we're not just answering questions. We are building our case. We're presenting our financial resume, detailing our car's safety features, structuring our policy for maximum value, and unlocking hidden group benefits. The real power isn't in any single discount, but in the art of stacking them. A good student with a safe car who bundles home and auto, pays in full, and gets an employer discount. That's how you take a reasonable quote and make it an unbeatable one. You're layering these savings one on top of the other, systematically chipping away at that premium until it's as low as it can possibly go. Now, with our discounts locked in, the system has everything it needs to calculate our final number. And here we are, the moment of truth. After all those pages, all those questions, all those decisions about liability, deductibles, and discounts, we are finally at the finish line. The system has crunched the numbers, factored in our vehicle, our driving record, our location, and every single discount we qualified for. So what's the damage? What is the final, all-in number that MetLife is offering for this 6-month policy? The screen refreshes, and there it is, laid out in black and white. Our 6-month premium is $762. Okay, let's break that down. $762 for 6 months. The system immediately gives you 2 primary payment options. The first and most common is the monthly payment plan. Dividing that by 6, our monthly payment comes out to $127 per month. The second option is to pay in full. And remember that paid in full discount we selected? This is where it kicks in. If we choose to pay the entire $762 up front, MetLife will knock off an additional percentage, bringing the total down to, let's say, around $725. That's a nearly $40 savings just for paying at the start of the policy instead of spreading it out. For many people, that's a no-brainer if the cash is available. So the big question is $127 a month a good deal? The answer is, it completely depends on your context, but based on the comprehensive coverage we selected, this is an extremely competitive rate. For a driver with a clean record, in a moderately populated area, with 100/300/100 liability limits, comprehensive and collision with a $500 deductible, and uninsured motorist coverage, a rate under $130 a month is a definite win. Many national averages for similar coverage packages push closer to the $160 or even $180 mark. But the price itself is only half the story. The real value is understanding why the price is what it is. This is where you need to become a detective and examine the quote summary page. Don't just look at the big number at the top. Scroll down. MetLife, like most insurers, will provide a detailed breakdown. You'll see a line-by-line itemization of your coverages and what each one contributes to the premium. You'll see bodily injury liability, $42, property damage liability, $31, collision coverage, $28, comprehensive, $12, and so on. This is powerful. This is transparency. You can see exactly where your money is going. Maybe you look at that and think, wow, collision is costing me almost $30 a month. Is it worth it for my 10-year-old car? This breakdown empowers you to make informed decisions. And right below the coverage breakdown, you'll find the discount summary. This is my favorite part. It's like a report card of your savings. It will literally list out every discount we applied and the dollar amount it's saving you. Multi-policy discount. Savings of $96 over the term. Good student discount. Savings of $72. Defensive driver course. Savings of $45. It quantifies the effort you put in. You're not just checking boxes. You're actively slashing the cost, and this section proves it. Seeing it all added up, you realize those little clicks saved you over $200 on your 6-month policy. That's significant. Now, before you even think about clicking the purchase button, let's talk about the single most important feature on this page. the Edit Selections or Change Coverages button. This is your playground. This is your laboratory. A quote is not a stone tablet. It's a living document. You have this incredibly powerful tool at your fingertips, so use it. What happens if we can't quite swing that $127 a month? Let's experiment. Click Edit Coverages. The system takes you right back to the coverage selection screen, with all your previous choices pre-filled. Let's make one single change. We're going to raise our collision deductible from $500 to $1,000. Remember, this means we're taking on more risk ourselves. If we get into an at-fault accident, we'll have to pay the first $1,000 out of pocket for repairs instead of $500. We click Update Quote. The wheel spins for a second and boom. The new monthly price is $115. Just like that, we save $12 a month or $144 a year by making one strategic adjustment. Is that the right move for you? Maybe, maybe not. But now you can make that decision based on hard data, not guesswork. You can weigh the $144 in guaranteed annual savings against the potential risk of an extra $500 out-of-pocket cost in an accident. Let's try another one. Go back and edit again. Let's see what happens if we lower our bodily injury liability limits from 100/300 down to the state minimum, which might be something like $25.50. We click Update Quote. The price drops again, maybe to $105 a month. Now, this is a much bigger decision with serious financial consequences if you're in a major accident, but the point is, the system allows you to see the immediate cause and effect. You can toggle these options back and forth, playing with different deductible and coverage combinations until you find the absolute sweet spot between protection and affordability that you are comfortable with. This ability to instantly model different scenarios is, without a doubt, the biggest advantage of getting a quote online. Once you've found a version of the quote you're happy with, it's time to think about comparison. It's very rare that you should take the very first quote you get, no matter how good it seems. Your goal now is to take this detailed MetLife quote and use it as your benchmark. Save it. They'll almost always give you an option to save and finish later, which will email you a link to your quote, complete with a quote ID number. Now, you take that quote summary, every single coverage limit, every single deductible, and you go to 2 or 3 other major insurance carriers' websites. You enter the exact same information. This is critical. You must compare apples to apples. A competitor's quote that's $20 cheaper is useless if it's for state minimum liability and a $2,000 deductible, when your MetLife quote was for robust coverage and a $500 deductible. You need to create an identical policy quote across multiple companies to know who is truly offering you the best rate for the protection you actually want. After you've done your due diligence and decided that the MetLife quote is indeed the one to beat, you navigate back to it using the link in your email. You give it one final review. Check the vehicle identification number. Double-check the spelling of all named drivers. Make sure the effective date for the policy to start is correct. Everything looks good. Now you're ready to proceed to purchase. This final stage is typically the simplest. You'll be taken to a payment screen. Here you'll confirm your payment plan, monthly or paid in full. You'll enter your payment information, either a credit card or an electronic funds transferred directly from your bank account. This is also where you'll set up autopay, which is often required for the best rates and to lock in another small discount. You'll authorize the payment, agree to the terms and conditions, and with one final click on a button that says Buy Policy or Complete Purchase, you're done. Instantly, you are insured. It's that fast. There's no waiting period. The system will immediately generate your policy documents. You'll see links to download your proof of insurance ID cards, your policy declarations page, and other important documents. A confirmation email with all of this attached will already be on its way to your inbox. You can print your ID cards right then and there and put them in your glove box. From a blank form to a fully active, legally binding insurance policy in under an hour. So we have our price, we've tweaked it to perfection, and we've completed the purchase. The hard part is over. But owning the policy is really just the beginning of your relationship with the insurance company. What happens next? How do you manage this policy you just bought? What if you get a new car or move to a new apartment? And the ultimate question, what is the process like if you actually have to file a claim? That moment of truth when you need the company to come through for you is what defines a great insurer. And that's exactly where we're headed next. So let's demystify it. Let's walk through that moment of truth together. Imagine this. You're leaving the grocery store on a busy Saturday afternoon. You're backing out of your parking spot, checking your mirrors, looking over your shoulder. Suddenly you hear that sickening crunch, that metallic groan that sinks deep into the pit of your stomach. You've just backed into another car. Your heart is pounding. Your mind is racing. What do? First, you take a deep breath. You put your car in park, turn it off, and get out. The most important thing in any accident, no matter how minor, is safety. You check on the other driver. Are they okay? Are you okay? Assuming everyone is uninjured, which is the best-case scenario for this kind of fender bender, the process begins. You exchange information. Not just names and phone numbers, but insurance information. You pull out your phone, and on it you have your MetLife digital ID card ready to go. You snap a few pictures of the damage on both cars, the license plates, and the general scene. This isn't just a good idea. It's crucial evidence for your claim. Now you're back in your car, the adrenaline is still pumping, but you know what you need to do next. You open the MetLife US app. Right there on the home screen, there's an option to report a claim. This is what they call the first notice of loss, or FNOL. The insurance world is full of acronyms, but this is the one that kicks everything into gear. You tap it. The app guides you through a series of simple questions. When did the accident happen? Where? You upload the photos you just took directly from your phone's gallery. You provide a brief, factual description of what happened. I was backing out of a parking space and collided with another vehicle. You don't need to admit fault or speculate. Just state the facts. You provide the other driver's information that you just collected. You hit submit. Within minutes, maybe even seconds, you get a confirmation, an email, and a notification. Your claim has been received. A claim number has been assigned. You're told that a claims adjuster will be in contact with you, usually within 1 business day. That single notification is a huge weight off your shoulders. The process has started. The abstract concept of insurance is now becoming a tangible service. The next day you get a call. It's your assigned MetLife claims adjuster. They introduce themselves, confirm the details of the incident, and explain the next steps with incredible clarity. They are your single point of contact through this whole ordeal. They'll ask for your version of events, listen patiently, and answer your questions. They'll explain how they will also contact the other driver to get their side of the story. This is the part of the process where the insurance company determines liability. Who was at fault? In a simple parking lot scenario where you were backing out, it's often straightforward. Your adjuster will then walk you through your coverage. Okay, they might say, I see you have collision coverage with a $500 deductible. This means your policy will cover the repairs to your vehicle, and you'll be responsible for the first $500. They'll also explain how your property damage liability coverage will handle the repairs for the other person's car. What about getting your car fixed? MetLife, like many major insurers, has a network of pre-approved repair shops. They might call it the MetLife Auto and Home Concierge Auto Repair Experience, or something similar. Using one of these shops can streamline the process. You don't have to run around getting multiple estimates. You take your car to the approved shop, they assess the damage, send the estimate directly to MetLife for approval, and once it's approved, they start the work. The insurance company pays the shop directly, minus your deductible, which you pay to the shop when you pick up your beautifully repaired car. And what if you need a car while yours is in the shop? This is where that rental reimbursement coverage we talked about earlier becomes a lifesaver. If you opted for it, your adjuster will help set you up with a rental car, and your policy will cover the cost up to your daily limit, for example $30 or $40 a day. Throughout this entire process, you can track the status of your claim through the app or the online portal. You see when the estimate is approved, when payment is issued to the shop, when the claim is closed. There's transparency. There's communication. The chaos and panic of that Saturday afternoon have been replaced by a clear, structured, and manageable process. This is what a good claims experience looks like. It's not just about the final check. It's about the communication, the empathy, and the efficiency that gets you from a moment of crisis back to a state of normalcy. And when we look at the data, this is where you can truly judge an insurer. Companies like J.D. Power conduct massive annual studies on auto claim satisfaction. They rank insurers on factors like the initial claim reporting, the adjuster, the repair process, and the final settlement. Before you ever sign on the dotted line, it is absolutely worth a quick search for insurance company name J.D. Power Claims Satisfaction Rating. This gives you a glimpse into how they perform when it matters most. For MetLife Auto and Home, which is now part of the Farmers Insurance family, you'd be looking at Farmers ratings, and historically, they perform respectably, often hovering around the industry average or slightly above. It's not just about the price you pay. It's about the peace of mind you're buying. And that brings our entire journey full circle. We started this deep dive with a simple goal: to understand how to get a MetLife auto insurance quote. But in reality, we've done so much more. We've peeled back the layers of an industry that can often feel intimidating and opaque. We started with the fundamentals, gathering the essential documents and information you need before you even visit a website: your driver's license, your vehicle identification number, your driving history. We prepared ourselves for success. Then we walked step by step through the digital quote process itself, navigating the questions about your vehicle, your driving habits, and the other drivers in your household. We saw how each piece of information you provide is a data point that helps an algorithm calculate your unique risk profile and, ultimately, your premium. We demystified the coverages. We moved beyond the confusing jargon and understood the real-world difference between liability and collision, comprehensive and uninsured motorist protection. You learn not just what to buy, but why you're buying it, empowering you to tailor a policy that protects your assets without overpaying for coverage you don't need. We uncovered the treasure map of discounts, the immense power of bundling your auto and home or renter's insurance, the rewards for being a safe driver, a good student, or for having safety features in your car. We learned that the first price you see is almost never the final price you have to pay. And just now we faced the ultimate test: the claims process. We saw how a well-designed system can bring order to chaos, and how the promise of a policy is fulfilled in your moment of need. The goal of this entire series was never just to sell you on a single company. It was to equip you, to give you the knowledge, the confidence, and the strategy to approach getting auto insurance not as a chore, but as a critical financial decision that you are now in complete control of. The principles we've discussed, the preparation, the understanding of coverages, the hunt for discounts, and the evaluation of claim service, they apply whether you're getting a quote from MetLife, Geico, Progressive, or your local independent agent. You are now a more informed, more empowered consumer. You know the right questions to ask. You know what to look for in a policy. You know how to spot opportunities to save hundreds, maybe even thousands of dollars a year. Your car is more than just a machine. It's your freedom. It's your connection to your job, your family, your life. And protecting it properly with a policy you understand and can afford is one of the cornerstones of financial stability. So now the power is in your hands. Take what you've learned here today. Go to the MetLife website, or the website of any insurer you're curious about. Start the process. You'll recognize the steps. The questions will be familiar. The terms will no longer be a foreign language. You are ready. You are equipped to find the best possible coverage at the best possible price, not just for your car, but for your peace of mind. Your journey to becoming a smarter insurance shopper is complete. Now go out there and put that knowledge into action.